All right. Welcome. Happy Tuesday. I hope everyone's having a good week. Welcome to the Wealth Management Stream. We got another episode today. I think you guys are really going to like it. It's a continuation of the last topic today. And today's a very special one because we have our portfolio manager, Gaston, with us today. And we're going to discuss a topic that's very relevant to investors, not just to investors, but to anybody that invests. So we've been covering behavioral biases at length lately because two streams ago we covered Vanguard's Advisor Alpha, which they found that what's called behavioral coaching has a 1.5% per year benefit to the receiver of it if they're actually receiving it. So, since not everybody provides that, we've been going into the details. What is behavioral coaching? If you're a do-it-yourselfer, how can you sort of behavioral coach yourself? Which is very difficult. But we were really zooming in on this topic because it's something we talk about constantly. Behavioral biases in investing all cost you money. So it's really something to avoid. Anytime our emotions and our biases get the better of us, it typically hurts us in the pocket and in our balance, in our wealth. So a key function, more than what a lot of people were thinking is the biggest value, things like managing the actual account, so rebalancing, the asset allocation, so what exactly is being invested in, what funds are exactly being invested in. All those things are very important. However, Vanguard found what trumps all of those is some other things. And number one on the list was behavioral coaching. So we've been delving into biases. What are biases? How can you recognize them real time? We covered several biases on stream. Make sure anybody who's joining us, the Facebook streaming, we're going to start phasing it out. We've been having a litany of problems with Facebook streaming. So about a week ago, we started a YouTube page. It's brand new, and we're broadcasting simultaneously to Facebook and YouTube. So the quality of the streams are way better on YouTube. So if you're having any problems with buffering or, hey, what's going on, Hugo? Good to see you, man. Anybody hanging out, just take into account the YouTube stream is much higher quality. Hop on there, give us a subscribe, and check it out. So today I also have some questions for you. I know last stream there was a lot of people got excited. I asked a couple basic problems, and I'll flash them on the screen again today. So if anybody who wasn't here could get an idea of what I asked you guys. It was two hypothetical scenarios. One where you stand to make a gain and one where you're mitigating a loss, and how would you act? Would you take a sure gain or a probability, or would you take the sure loss or a probability? And then we crunched the numbers to give you guys an idea of what's the mathematically best decision to make if you were to crunch the stats. And a lot of people didn't answer in line with the stats, which is very normal, very human. And the reason why people do that, we're going to cover today. And it has to do with things like utility. And everyone's situation is different. So different losses, different gains mean different things for individuals depending on their situation in their life. You know, a certain loss to somebody can be not that big of a deal, and a certain loss to somebody else could be devastating. So some of these questions are meant to push your buttons and trigger emotional responses and kind of trick you into answering them wrong. But I think that's the fun part of it, because the same thing happens to us when dramatic news comes out or when the markets fluctuate dramatically, and then we see our balance or our wealth fluctuate dramatically. That really inspires intense emotional responses, right? And how you deal with them, and especially being coached through them, is what gives that big benefit that Vanguard found to be 1.5% per year, which is massive. I've said before, especially for high net worth investors, 1.5% could be almost all that they need in a given year. You know, maybe 2 or 3% while protecting their capital is all that they need. So things like behavioral coaching and some of the other ones are just huge, And especially even if you're younger and you're building your wealth and you have 50, 60 years ahead of you, 1.5% compounds over 50, 60 years to have a massive effect. So that's why it's so important. That's why we cover it. And we're going to delve deeper into that today. So with that being said, just quick intro. This is the Wealth Management Show. I'm your host, John Paul, co-founder of Rushlight Investments. I'm a private wealth manager. What I do is I keep the client's 30,000 foot view goals in mind at all times and work in everything from estate planning to asset protection to tax planning to portfolios. Make sure everything's working towards that goal. Today we have with us Gaston, which is a portfolio management specialist, and he's a critical component in that equation of wealth management. So he's going to give you the technical side, and I urge anybody hanging out to, if you have a portfolio question, today's the day to ask it, because you'll be able to have a portfolio management specialist answer it as well. So welcome any of your comments. Shortly, in a moment, I'm going to put some questions on the screen for you guys to answer, and I really want to know what you guys think, what comes to mind. They're simple questions, so you don't have to be an expert to be able to answer them. They're not highly technical or anything like that, but they're going to push some bias buttons in your brain, and we're going to see how it all pans out. And then afterwards, we'll discuss the answers. We'll discuss what are the right answers and what happened if you didn't answer it correctly mentally. What sort of buttons were pushed and why did it force you to answer a certain way? So with that being said, I'd love to introduce. First of all, I'd love to introduce Gaston. Let me get him on the screen here, and I'm gonna at the same time review the question from the last stream so you guys could see it. So let me see if this is the one. Yeah, this is the one from last stream. So we, hey, well, first of all, how's it going, Gaston? Just make sure we got a quick mic check here and that everything's good with the connection.
Hey, what's up?
Hey, how's it going, man? All right,
Hey.
everything sounds good. Everything sounds good. So this was the question we posed to the viewers last stream. You have two decisions to make. Decision one, you have a guaranteed $7,000 gain, or option B, you have an 80% chance to gain more, but then a 20% chance you gain nothing. So it makes you think things like, a bird in the hand versus two in the bush. Maybe I'd take the guaranteed gain. And then we crunched the numbers and showed you that option B has a higher mathematical expected return. So if you're going strictly off the math, not going off any sort of emotions or anything like that, you might likely pick B. And then by the same token, an opposite example where there was a loss involved, you had to make a decision, either a guaranteed $7,000 loss or a probability to lose even more, right? 80% chance to lose 10,000 or 20% chance to lose nothing. And this one is an opposite side of the equation, right? It's not a gain but a loss that we're sort of managing, let's say. And the right answer is actually the guaranteed loss from a mathematical perspective. And where you crunch the numbers and you see option D, although I have a chance to make it out with no loss, the expected outcome is an $8,000 loss if you crunch, the 80% and the 20% number. So it kind of puts you in an awkward position where nobody likes taking a guaranteed loss. It seems very unappealing, right? But the other option where you have a possibility of not losing anything at all puts you in a mathematically inferior position than the guaranteed loss of C. So what I wanted to talk about today was some more realistic examples of this, maybe variations of questions like this that have more tangible implications, so a situation attached to them. So you could imagine if I mentioned in decision 2, a $10,000 loss, however, means that you won't be able to pay an important bill this month, and 7,000 you'll still have enough. That's going to change the dynamic. Even if you might want to go for the chance, what if it's just going to mean serious ramifications? So real life typically carries, depending on who you are, how much you're investing, what portion of the bet is this representing, the question at hand. All those things have a very, very meaningful impact that go a bit beyond the math. So we're going to talk about how does that apply to actual investing. And we're going to cover a couple new questions for you guys in literally just a moment here. I would love to know what you guys have to say about it, and I would love to hear your answers. So with that being said, Gaston, I think I'm going to hop into the question. We'll ask the behavioral bias questions. We'll see what anybody has to say, and then we'll take the conversation from there. We'll dig deeper into the behavioral side, and today we're going to talk about something called utility briefly, which Gaston is very well versed in, and it impacts portfolio management. It's actually at the cutting edge of portfolio management, some of these things we're going to be talking about. And lastly, we'll contrast that to what's being done, as we could tell you from experience in the field, that's not at the cutting edge. So, when you think of maybe you want somebody to take care of a medical issue, you want them to be using the latest, greatest tools. What about wealth management? What about your portfolio? I'd say the same goes for that. So we're going to discuss a bit of that today. And let me switch on over here. We're going to do the questions right now. The bias problem right here. Okay, so listen, guys. This is going to be timed. You could write it down or put it in the comment section. You're only going to have, let's say, 2 minutes to answer these questions. They're already on the screen. You could be reading them. I'll read them out loud for you. So a lily pad doubles in size every single day. If it takes 48 days to cover an entire pond, on what day will the lily pad cover half the pond? Question 2. A bat and a ball together cost $1.10. The bat costs $1 more than the ball. How much does the ball cost? And the last one, it takes 5 machines, 5 minutes to create 5 widgets. How long would it then take 100 machines to create 100 widgets? So we'll wait here. Just give you guys a minute. Let that sink in. Just they're simple questions. You should be able to answer these. Take a moment, jot down, any diagrams on a piece of paper that you need to work out the math. And we'll in a moment reveal the answers and talk about what's happening here. What might be happening mentally when you're presented with problems like this. And in general, I've talked to you guys a lot about biases, and the difficult part about them is they're very natural. They're natural ways our minds work to solve different problems, to either quickly and efficiently attack different issues and decisions that we need to make. It kind of comes down to things like, the whole theory of when we were in the jungle, a part of our brain is wired to make very quick decisions because they could be life and death. And when it comes to decision making, and okay, so Hugo, okay, we got some answers from Hugo. I like that. All right. Okay. In a moment here, we're gonna wrap it up because it's time. The whole idea of these problems is you need to make them quickly. So it's gonna push some buttons in your mind, the bias buttons in your mind. So okay, I see you here, Hugo. I see it. All right, we got like 10 seconds left. And then here we go with the answers coming in now. All right, boom. So you did pretty well. I hope Gaston has on, because there's some stats on these specific questions. They were asked to very, very many people. So we have some percentages on how many people got them correct and how many people got them incorrect, how many people got them all correct. So I see Hugo here got 2 of 3, which is great. Do you mind reviewing? I don't know if you have them handy by any chance, Gaston. What percentage of people got all of them correct in the people surveyed?
Yeah, 17% of all people got all 3 correct, but 40% of professional investors got all 3 correct.
Right. Okay, so number 2. I see Hugo there, number 2. Okay, yeah, so look, if the ball costs 5 cents and the bat costs $1 more, the bat would cost $1.05. So $1.05 plus 5 cents equals 110. But The absolute, undoubtedly most common answer when it's incorrect is 10 cents, because you think, 110, 10 cents, the bat's a dollar more, 110. But not really, because if the ball was 10 cents, the bat would be a dollar and 10 cents, so you'd come up with a dollar 20. And can you comment on them, because this has to do with, a little bit, I believe these are taken from Thinking Fast and Slow, right? And a little bit on our mind and the two modes type of thing and decision making, for a moment.
Yeah. So, according to Daniel Kahneman, who's the the author of the book Thinking Fast and Slow, I don't know if you talked about that book before on the stream.
No, no.
Um, oh, okay. Well, um, he basically divides it into he divides your brain or your mind into two systems, which he calls system one and system two. System one is very quick, intuitive, um, and effortless. System two requires effort, it's slower, but it's more logical. So basically how it works is you have the two systems in your brain or in your mind. Um, and usually how it works is people navigate the world using mostly system one. And system one is quick, um, often effective, but sometimes can make you fall into very big traps or make very big mistakes that could have been avoided had you put more effort into the thinking, right? And that's system two. So these questions are essentially an example of how people usually navigate the world using system one. I mean, if you're reading the book, sort of an autopilot, let's say, you get to this part of the book and you kind of do the questions, the more you're reading passively, the more of these questions you will get incorrectly. But if you were reading the book very analytically, very logically, very methodically, then it's likely that when you get to these questions, you'll answer them more like system two. So you'll get them all right. So this isn't like an IQ test, right? It's not showing how smart you are, how intelligent you are, nothing like that. All this exercise is showing is that people essentially live their lives on autopilot a big portion of the time. And that leads people to not process information with the care that they should. That's basically what this shows.
Yeah, yeah, and then to bring it back to the biases part of it as well, the way that biases work, to me, one of the most profound things that I read or learned about as I study behavioral biases is leaders in the field talk about committing these things that they've studied for basically a lifetime, studied way more than almost anybody else, winners of prizes in research in these areas, talk about how when they're not being vigilant and that mental effort isn't at its maximum, they commit these same biases that they've studied, that they've won prizes for, that they've published literature on, etc. So it's not and these are very smart individuals, academics, PhDs, where they're committing the same things. It's not to emphasize the fact that it's not an IQ test. It's more of a our brain has these modes, and when we're in more of that quick thinking, what's called system one mode by Kahneman in his book, is we're very susceptible to biases. So, taking little shortcuts and using rules of thumb or very quick math to arrive at conclusions, and to extrapolate that into wealth management and decision making, you got to think about this. Some people really don't like thinking about wealth management topics. Some people really don't like making these decisions that are part of a 50-year plan, that have impacts that are going to resonate and have ripples into the future. So if you already are maybe, taking a passive approach to your wealth management, where are you system one thinking, and where are you allowing these biases to come in, and then to exacerbate things when we're feeling emotional as a response to a market movement, dramatic news. We all saw what happened to the market during the initial shutting down of the economy during coronavirus. it was pretty dramatic, right? And I know that I was on the phone quite a bit during that time because, you know, emotions were high. You know, people were quite worried of what they were seeing. And when you're in that mode, it's so easy to disregard, you know, the slower, more methodical thought processes. And your mind is just assaulted by biases coming in from the left, from the right, etc. And to give you an example, I love having this as an illustration. These were the biases that we covered 2 streams ago. If you anybody watching on Facebook, I urge you to please come over to the YouTube page. The stream quality is much better, and you'll be able to see all our past replays easily in the library there. And this is simply 4 that I thought were relevant to the topic of the day. But if you go on the Wikipedia page of the list of cognitive biases, I'll just quickly scroll through them again. Done this several times. It's a massive amount. And these are ways that our minds are naturally programmed to think, especially when we're not vigilant, as we're talking about here, this whole system 1, system 2. And when it comes to behavioral coaching, which is that big benefit that Vanguard found, you need to be in a mode. We are trained for this. So that's why it's something that's offered by us and that we do professionally. But when you think about what happens in our industry, what's the anatomy of a typical annual review? Oh, let's look at performance. This didn't do so good. You know, maybe we'll swap this out, etc. That isn't behavioral coaching. What behavioral coaching has to do with is in bad times, not switching things around, or not when we're unhappy about something. You need to design things properly from the beginning, from the risk level, like I talk about all the time. And then once that is solved, the way that you get that 1.5% that Vanguard is talking about is behavioral coaching. So talking about certain issues like this, covering actual biases. Sorry, let me switch back to the answers. Covering actual biases and what do they mean, how do they come up. Going through exercises is one way that you could arm yourself for the future. You understand? So I hope that you guys start understanding that this is the key. It seems simple. I think it's quite fun because it's sort of all the ways our minds play tricks on us, you know, and avoiding that in the future is a massively great thing to do. So that's sort of the bias side of the equation. And now I want to shift the conversation to what do you mean, Hugo? What do you mean? What is question 3? I want to shift the conversation to utility, okay? Because going back to this problem that we had last stream, it's a very simple problem and it's completely hypothetical. So I want to give you guys an illustration of what if we put some real life parameters behind this. So what if we attached a story and some criteria to a decision like this? How would our reasoning change? Because we took the mathematical approach when we were thinking about these questions and answering them on stream. So what about if we had a situation like this? So situation 1, a 25-year-old single man is given the opportunity to flip a coin. If he guesses correctly, he gets $1 million. If he guesses incorrectly, he must pay $10,000. Here's a little bit of situational information. Besides that he's 25 and single and etc. He could save another $10,000 in just a few months of aggressive saving if he needed to. Okay? Oh, yes. Real quick, just for the viewers who are asking, look, in this, since I didn't cover question 3 explicitly, well, if it takes 5 machines 5 minutes to create 5 widgets, that means each machine in 5 minutes will create 1. So if we had 100 machines, it would still take them 5 minutes to output 100 widgets, because 5 minutes later, each machine would have outputted 1. Just like in the beginning where it says 5 machines, 5 widgets, 5 minutes. So it wouldn't be 100 minutes. That's one of the shortcuts that people will take mentally, or you know, some variation of that. Or but 5 minutes is still the answer, because you just multiplied the number of machines, so that multiplies the output. So you got that one correct, I believe. Yes, it was good. So going back to this question. So we have that 25-year-old single man. He's got a coin flip opportunity. If he guesses right, he gets $1 million, but if he guesses wrong, he loses 10,000. So that means he's getting paid a factor of 100%. I think 100 times what he will have to pay, he will gain if he wins. Okay? And a side note is he could save another 10,000. So he has the 10,000 to lose. And if he needed to in a few months, he could save that same 10,000 again. So it wouldn't be a major setback. What would you tell him to do? On the flip side, we're going to have a situation with the same exact probability. So it's a coin flip, 50-50, and 100 times the gain versus the loss. But this time it's a 65-year-old man that's given the opportunity to flip a coin. If he guesses correctly, he gets $1 billion. If he guesses incorrectly, he must pay 10 million. His entire net worth, however, and his life savings is 10 million. Okay? So, like I said, it's still a 50-50 coin flip. We're still talking, if you win, you're going to gain 100 times what you'll lose if you do lose the coin flip. But in this case, we're talking an older gentleman who it's his entire net worth and savings. What would you now tell him to do? Because the idea here is they're still mathematically identical outputs, right? We're still talking 50-50. The win is 100 times the loss. If we were to calculate the percentage expected return on both of these, it would be absolutely the exact same output. And if we took the purely mathematical approach, forget about the old man and his situation, forget about the younger man and his situation, we would just obviously tell them both to absolutely go for it. It's got a positive expected return and dramatic expected return at that. So I hope this illustrates for you guys how differently would we approach this. I'd assume all of you would tell the 25-year-old gentleman, absolutely do it. And all of you would tell a 65-year-old gentleman, absolutely do not do it. Okay? So, hey, Tom, great to see you. Exactly. Read Tversky and Kahneman. Yes. Gaston, Tom Penny's actually joining us. He was talking about Kahneman. That's exactly what we were covering a minute ago. We actually gave some examples from his from the Thinking Fast and Slow book that he poses the readers. I'm not sure, you're probably familiar with them right here, the lily pad, the bat and the ball question, and the widgets. So we were talking about, system 1, system 2. We're talking about how when you're not vigilant and cognizant and using system 2 thinking, you're very, very, very susceptible to behavioral biases, which is something we've covered at length through these live streams. So we're starting to bring it more into from theoretical perspective into reality. So what are some questions that really push those buttons? Kahneman's examples were great examples, so we brought them up. And then we're now starting to sort of segue into utility, right? Where we've covered a question where we asked viewers, what would you pick in situation A, B? And the correct answer was the mathematical result. What's the higher expected return? It was sort of a question that plays a trick on you there. But here, when we start sort of morphing it to an example that has impacts on someone's utility, i.e. what their life is going to be like, the impact on their life, we get into something like this where it's a dramatically different response you're going to have. I know the numbers are different, but what it really comes down to is the 65-year-old in scenario 2 is risking everything, okay? Whereas the 25-year-old in situation 1 is risking, a couple months of savings, of aggressive savings? And the impact on your life for a loss in these two scenarios is dramatically different. So I don't know if before we move on, if Gaston, you have any comments on sort of the segueing into utility, because it starts going from math to impact on your life, and there's a way to segue into that and not do it feelings based. This dramatic example makes it very obvious that number one should probably do it and number two should absolutely not do it. But there's ways to actually quantify these things, and it's at the cutting edge of research actually. So I'd love to for you to kind of give them the intro on that. Any thoughts you have before we go on?
Yeah, I mean, I could speak about whatever you want me to speak, man. You just let me know. You want me to explain this example?
Yeah, this example and how it might tie into, and then maybe we get a slightly less dramatic example on, an investor is typically looking at different choices that aren't so maybe obviously different, but will impact their utility. You know what I'm saying?
Okay. I mean, the way that I would look at this is, um, like, yeah, this example, I guess, does make some sort of sense from a superficial, maybe system one perspective, but if you were going to analyze things from a system two perspective, I don't know if I would, yeah, like you were saying, I would formalize it more. And then how you formalize these sorts of questions, um, is by creating some sort of mathematical structure where you could, express preferences and risk tolerance and uh, things like that. So essentially, the big mistake that is being made with this example, or the big problem that's being faced by this example, is that you're essentially processing it from a perspective of constant risk aversion, essentially. And so there's basically two types of mathematical models to create a utility curve or risk aversion curve. There's absolute risk aversion and relative risk aversion. And just to keep it simple and make it easy, because I don't want to go too deep into things, absolute risk aversion essentially says that your utility evaluations will be disconnected from your net worth or how much money you have. Right? And then when you have absolute risk aversion, you usually frame questions in terms of dollar amounts because it's irrelevant, what that dollar amount is relative to the net worth that somebody has. So you could even frame a question of like, oh, would you invest $10 million if your chance is 80% that you will make more money? You could ask that to somebody who doesn't have $10 million. And it would still be a valid question. You understand what I'm saying?
Right.
But that's not how reality works, because if there's a bet that requires $10 million and you don't have any money, then that's an invalid question for you essentially. So how do you get over? Also, even if you did have the $10 million or whatever, and you bet a bunch of times, you would end up with more or less money than you started with. So essentially, the question, how you interpret the question, would be changing every trial, and you don't want to do that. I mean, you could do that if you wanted to, but it's not convenient and it's not necessary to do that. And then you also get into problems later on because of the uh, ergodicity of the return stream, essentially. So, how a more useful way, I would say, to look at things is, instead of using absolute risk aversion, where you use dollar amounts, switch the analysis to what's called a relative risk aversion. And when you use relative risk aversion, you stop dealing with dollar numbers and you start dealing with percentages. So you no longer ask, would you bet 10 million if you have 10 million, or would you bet 10,000 if you have 50,000? You no longer ask that. Now you ask, would you bet this percent of your money, right? For this probability to increase your wealth by this much percent. So by switching from dollars to percentages, now every bet is relative to the net worth in a percentage term, and that percentage will be static. You understand what I'm saying? Whereas the dollar amount wouldn't be static, because if you have $10,000 and if you have $20,000, a $5,000 amount will be a different percentage. But if you're betting 10% every time, you're keeping the percentage amount constant that you're betting, and then it becomes irrelevant like how much money you have. It doesn't really matter if you have 1,000 or 10 million. When you're dealing with percentages, you can basically disregard the starting amount.
Right.
And
And
then
then
basically, Yeah,
No,
sorry.
no, and I was going to say, and to bring it to a real sort of example, an actual investor will have decisions to make where, um, there's trade-offs in every decision where, there might be a slightly higher gain in scenario A, slightly less in scenario B, but then maybe scenario B is more certain than scenario A, right? Like risk return is, let's say we're having efficient portfolios in both instances. So there's more return here, but higher risk, less return here, lower risk. And if that's the case, there's going to be impacts on utility. What if the higher risk starts jeopardizing a key goal or is way too big of a loss to your percentage net worth? There's impacts on utility here that are less dramatic, and they're typically, like Gaston is talking about, in percentages, where it gives you the same idea of, well, depending on the situation, depending what exactly is at stake, is going to impact my decision, regardless of what the math is saying, regardless if the math is saying this is a positive thing or you have a positive expectation here in general. A lot of times that's more of a also a realistic example of what an actual investor might face when they have these choices in front of them. So I would like to talk about the fact that some of this is he mentioned ergodicity. Like some of this is actually very, very new research. What's impacting how utility is looked at and how we talk about some of these things. And like I mentioned all the time, wealth management, finance is just like any other technical field, that there's constantly developments happening, and how we look at things, how to make decisions in the best way possible is changing over time. Just like, now with the technology we have, surgeries, a lot of them look nothing like they looked like in the past, and that's a positive thing. They're a result of developments in the literature, in the research. So in finance is very much the same way. In finance, statistics, wealth management, portfolio management, all these are fields that are constantly developing. And some of these concepts and certain changes that are happening to the way that we look at things like utility are within the last few years, sort of developments. And they're changing the way that we look at things.
Yeah, so I mean, so like I said, this example, I don't know if it's the best because in number one, you're essentially measuring the cost as a percentage of somebody's income to some degree, and then the second one, you're doing it as a percentage of net worth.
Right.
So I don't know. I mean, I think the previous example was better maybe to explain the difference between mathematical expectation and utility.
You're talking about this one right here, the bias problem posed before with the guaranteed loss and the chance of loss?
Yes, yes.
Yes.
So, okay, so this is a much better problem to, I think, explain the difference
Perfect.
between mathematical expectation. So, what essentially by the way, this was an exercise. It's not like you were saying, like this is the only true answer or whatever. I mean, it's just an exercise. So, in terms of mathematical expectation, I think the answers that you provided were correct, right? So if you have an 80% chance of a $10,000 gain and a 20% chance of no gain, I don't know if you went over like the formula for mathematical expectation, but you multiply the probability times the payoff and then you add everything.
Right. And then you would get an output of $8,000 gain for option B. Let's,
Yes.
for example.
Yeah. So basically, decision one is basically telling you what would you rather have, 7,000 for sure or 8,000 with an 80% chance, basically. And then, well, expectation wise, but the actual
Expectation of
problem is
8,000.
10,000. Yeah.
Yeah.
So either way, so check this out. The expectation is 8,000, right? So it's bigger than the expectation of the first one. But then also like the max value is also bigger. And
Right.
that's important for like later because there's some people that um, put a lot of weight on like the max gain, right? So basically how it works is the mathematical expectation will tell you that B is greater. And then how you get mathematical expectation is the sum of the products of the payoffs and probabilities. Okay, so the problem with that, from a mathematical perspective,
Right.
is that you're essentially creating a linear extrapolation of expectations, um, which that's not how human beings process information. And then how do we know that's not how human beings process information? Well, the reason that we know that is because the field of behavioral economics tries to understand how people actually make decisions rather than how they should make decisions, right? So there's like the normative economics and there's positive economics, and the two fields are slightly different in the sense that one tries to determine how do people actually behave in reality, and then the other one kind of tries to figure out how should people behave if they want to optimize their utility.
Right.
Behavioral economics, it deals more with how people actually behave and then trying to understand why is it that people behave that way, and should they correct the way that they naturally behave, or is that for a reason, or is there a good like evolutionary or mathematical reason for that sort of behavior. So essentially what behavioral economics found out is that people do not linearly extrapolate payoffs. And then much later on, you'll see that there's a really good reason for that. Even though mathematically it doesn't seem like there should necessarily be a good reason for that, there is actually a good reason. And it has to do with survival and evolutionary economics and things like that, and just how your brain processes information and the inaccuracies that you have in projecting the future and your own emotional state going forward. It's just a
Right.
lot of things. But essentially, the key thing is that humans do not make decisions on mathematical expectations, and they should not make decisions on mathematical expectation. And there's like really, really good reasons for that. Now, there's something similar that's related to that, which is the concept of like risk tolerance. And then what is risk tolerance, right? Um, or risk aversion. That's another way to. It's the flip side of it. Risk tolerance is how much you can tolerate in terms of risk, and then risk aversion is how much you dislike risk. So it's basically the same thing. But so risk aversion is essentially the tendency of humans to prefer outcomes with low uncertainty relative to outcomes with high uncertainty. And then so here's an example given by Wikipedia, for example, just to illustrate how the same mathematical expectation could be completely different to like different people, given the risk tolerance or risk aversion.
And one
So
moment, hold that thought, Tom.
yeah,
I saw your question. We're gonna get that to that the moment Gaston's done with this example. So we're coming up on that.
okay, so um, let's just say there's two scenarios. In one scenario, you receive $50 for sure. In another scenario, you flip a coin and you either receive $100 or nothing. Okay, that's the setup or whatever, and then the mathematical expectation is the same. So getting $50 for sure and getting $100 or zero with 50% probability, the mathematical expectation is the same.
Right. It's expected $50, guaranteed $50.
Right. But obviously, if you map out how, a scenario analysis, you'll see that in one situation you end up with $50. In the other situation, you either end up with 100 or zero.
Right.
So even though the mathematical expectation is the same, reality will not be the same for those two.
Right. Right.
So
Right.
so so that's the first sign that something is wrong.
Yes.
Because these equations they should be the same, but in reality they're not the same. So math is not matching reality to some degree. So then what? Okay, so that's what happens. So what we have to do is we have to do something to the mathematical expectation equation to try to match it better with how humans make decisions and how humans perceive outcomes. Because even probabilistic forecasts will be binary in outcome, right? Like things are probabilistic before the fact, but after the fact, they're binary. Like it either happened or it didn't.
Mm-hmm.
It's only before the fact that we talk about. It's kind of like quantum mechanics. Like things things are uncertain before being measured, but then once you measure, there's some resolution of uncertainty. So it's kind of like that in investments as well. That's why it's not super intuitive. Okay, so what do you do? the act of essentially correcting the mathematical expectation equation to match a user's utility um, is the field of utility theory. And then basically, utility is a curve. It's a dynamic curve. So it's a curve that has gains and losses, and then the pleasure that you'll feel for like every amount of possible gain, and the pain that you'll feel for every amount of possible loss, and then the shape of that curve changes over time. Okay, so it's a dynamic uh, term structure essentially of utility. And then, by the way, your the chances that you'll uh, correctly forecast the movement of your utility curves is extremely low, given behavioral biases.
Right, right. Yeah. Given behavioral
So
biases, you're the worst person to determine it, actually.
yeah, so what happens is if somebody is risk neutral, that's what they call it, risk neutral.
Right.
They will bet according to mathematical expectation. Okay, like their utility equals mathematical expectation. That's called a risk neutral person. I've never met any of those, but theoretically, I guess they may exist. Um, so then the next category is risk loving people, and then risk loving people will will gamble it even if the expectation is lower. So like for example, let's just say in the example it was like $50 for sure, or $90 or $0.
Right.
Okay, with 50-50 chance. So now you should take the 50.
Right.
But risk loving people just can't get their mind off that $90.
Well, casinos are an ongoing business for how long now, right?
Yeah,
Without
yeah,
risk lovers, it wouldn't be a thing. It wouldn't be a reality.
right. And by the way, not everybody loses. So by definition, a coin flip, half people are going to win. So half
Right.
people are going to get $90 instead of 50.
Right.
That's depending where you're coming from, what you're thinking about, how you're processing information. That may or may not be a thing for you. You
Right.
know,
Right.
like if you need to buy something that's $80 and you only have 50, and you have to buy that thing. I don't know. Maybe it is worth gambling the $50 because you wouldn't be able to get it anyways. And then there's a 50% chance that you'll actually be able to do what you need to do versus a 0% chance. So that's called risk loving. And like I said, these things are dynamic. They could change situation by situation. It's not like static for a person cross sectionally or intertemporally.
Right.
It's extremely dynamic. And
Right.
then,
The
like I said,
context shifts the
yes,
utility curve. Just like in that utility example we gave some context to shift you away from the mathematical decision, just the outright mathematical decision, just to illustrate that simple fact of how much context influences utility, and the impact.
yeah. No, especially if you don't define the problem structurally properly. And to define it structurally properly requires a lot of work. And yeah, it's not something that's a DIY type of thing. Like you need
Right.
to work with professionals and stuff.
Right.
Okay, so that's the second category. The third category is the biggest category. So like most behavioral economic papers that have gone out and tried to figure out how do people actually make decisions, what they discover is that most people are risk adverse. So most people do not like taking risk. Most people, if you said, do you want $50 for sure or 50-50, 100-0, they will take the $50, okay? Because they don't want to take that risk. As a matter of fact, they found out that people are so risk averse, okay, that for them to take the uncertain bet, you would have to, it would have to be disproportionately high, the expected outcome. So
Right.
essentially, if a risk averse person was going to choose the uncertain versus the certain one, you would have to offer them like $50 for certain versus like $500 or zero. You
Right.
understand what I'm saying? And then in that case, you're comparing a $50 expected mathematical expectation to a $250 mathematical expectation. And then when you get to these levels, people start making the risky decision.
Right.
Okay. And then, by the way, that's the source of what they call the equity premium puzzle. Whatever, unrelated but kind of related. Um, so basically, what happens is people are risk averse, so they demand more than what would make up for the mathematical expectation. You
Right.
understand what I'm
Right.
saying?
Yeah,
And that's
absolutely.
what's That's what's essentially called in finance the risk premium. That literally that's what the risk premium is. It's just, you go into different fields, but basically that's what it is. It's based on utility theory, like at the end of the day. And then the dominant theory in all of finance and economics for a long time was the consumption CAPM, which essentially tells you like exactly why, your utility should be related to your expected return or your required rate of return. John
Right.
Cochrane goes into that in his book Asset Pricing. So, okay,
So,
there's three categories: risk loving, risk neutral, risk seeking. Most people are risk averse.
right.
They don't like risk, right? Here's another important point that this problem brings out. According to and I think Tom mentioned it. According to prospect theory, your utility curve is asymmetrical to the positive and to the negative side. What that means is that a 10% gain and a 10% loss will not give you the same pleasure or pain. Same thing with an 80% gain, 80% loss. I mean, it doesn't matter. Like equivalent gains and losses will not give you equivalent positive and negative utility. And what they found is that usually, just to approximate here, every loss will give you 2x the negative utility that the equivalent gains gives you. So, for example, if for a 10% gain, you would need a 5% loss to essentially be neutral from an emotional perspective, because you would interpret a 10% gain just as pleasurable as a 5% loss is displeasing.
Right. Right.
You understand what I'm saying? So that's basically what prospect theory found, that not only is utility nonlinear, but it's asymmetrical, right? So then basically, once you get to that level of complexity, there's really no way to do these things other than like working out the math and mapping out some sort of utility curve and stuff. But like you do have to realize that if somebody on decision number one picks A, they're not necessarily irrational, and they're not necessarily biased. They're not necessarily committing a fallacy. It could
Exactly.
just be that they're very, very risk averse.
Right.
They just hate risk,
Right.
right?
Right. Right.
So there's a very big difference between risk tolerance and preferences and utility,
Yeah.
right? And then the topic of behavioral biases. Those are different things. They do interact, but they're different things. Utility theory has mostly to do with what you like and what you don't like, and then limiting things so that you end up with positive utility or maximizing utility, if that can be done. Whereas behavioral biases deals with, given that you have the mathematical structure of your utility curve, the output is only going to be as good as the inputs. So if I ask you, how risk averse are you from 1 to 10? And then you give me a wrong answer to that. So let's just say you're 8, but you tell me 4, okay, because of some behavioral bias or because the psychological state that you're in right now. Well, I can plug that number into the perfect utility curve equation, right? But we're going to invest in a way that you're not happy with, because essentially, even though the system worked, the inputs were inaccurate.
Right.
And a
Right.
system's only as good as its inputs. So how do you get the proper inputs into this utility curve computation? Well, you need to work with a behavioral coach that's well
Absolutely.
versed in specifically at least the top 5 or 10 biases that obliterate the majority of people.
Yeah, no, no, I was about to say you're starting to touch on sort of how these things mesh together because, like I was alluding to, there's mathematical ways and developments that allow you to sort of map a utility curve that's personal to you. So, how you are going to feel. Yes, everyone's is dynamic, context influences it, but you could build one that describes your pain and your pleasure at different gains, losses, etc. Right? But you're going to have to answer questions and have conversations to be able to plug in to building that curve. And you are the most biased individual to answer questions about yourself. There's specific biases that deal with how bad we are at projecting how we're going to feel in the future, because things change. We might be, like Gaston said, in a certain emotional state today while we're answering those questions, and it might be different tomorrow. our life might have dramatically changed and we have a slightly different view in the future. So all of these things come into play that are going to bias your answers, even using the perfect tools to map your utility. So that's the sort of the interplay between, we're talking about two separate topics here: behavioral biases and how they influence, but then also the concept of utility and how it could be used. And there's an interplay there. And not just that, after a utility curve is mapped and a perfect solution is arrived at, the ongoing sticking to the plan deals with behavioral coaching as well. So having the right inputs into the utility functions absolutely requires behavioral coaching and making sure everything's accurate and true to how you actually feel. But then ongoing, once it's built, sticking to the plan through adversity and as things change, that's exactly behavioral coaching's arena right there as well. So I wanted to get to Tom's question, and I hope you could answer it for him, Tom. Gaston, I think it's the perfect question for you to answer. Tom asks, departing from abstract utility, how does your company capture the individual utility of your investors? So how do you tackle that problem as a professional in an individualized way?
Well, by spending extreme amounts of time with each client. That's essentially how. Because there's no way you're going to be able to capture a client's individual utility through a questionnaire or through a 2-hour meeting one day. Like I explained this earlier in the video, that utility curves are dynamic. They're situation dependent. They're conditional. Okay, so there's no way you could be like, oh, look, this is this guy's utility curve, and that's it, and then invest based on that for 20 years. I wish it were that simple. That would be beautiful and it would be simple, but that's just not how reality functions. So the only way that you can make sure that your client's portfolio is aligned to their utility curves is by keeping in touch with them on a constant basis, constantly working through behavioral biases that may be arising or they may be expressing, um, and keeping up with the academic research on learning if you can map these things a little bit more flexibly so that your client can make more mistakes in communication without like ruining the plan that you got going on. The more flexible your systems are in terms of resisting mistakes, the better they are, of course. But there's a limit to that. Beyond a certain point, it becomes garbage in, garbage out. And the only way to get really good inputs is to spend the time with each of your clients, and unfortunately, most people in most institutions aren't set up to be able to do that. But there's really no way around it.
Yeah, I think a lot of people, especially if they're a consumer of advice, they could attest to this. It's fill out this form. All right, perfect. Now the portfolio side of things are done. But you have to understand what we've gotten into here today in terms of talking about utility, behavioral coaching. That sort of approach is not at the cutting edge, is not utilizing these tools and techniques that we're talking to you guys about today. That may be the status quo, but that's not at the cutting edge, and it's not the limits of what can be done with the technology and what we have in terms of research and findings at all. So, and that's very much the approach. A form that you fill out yourself, as we described, due to behavioral biases, you're the worst person to just completely by yourself fill out this form. The inputs are sort of compromised from your own biases due to your own biases. And then assuming those inputs can be properly put in and accurately put in, just outputting the answers to these sliding 1 through 5 questions are going to spit out a utility curve or a portfolio that takes this stuff into account is ridiculous. It absolutely isn't. You can't accomplish it in that manner. You just can't.
Yeah, but you kind of know, if you spend enough time with your clients, you'll know. Some people want the big gains, and they'll push you to go into like option stuff, because they like buying options for the possible home run. Other people aren't into that, and they want they're just paranoid in regards to everything: interest rates, growth rates, inflation, everything, and they want just max safety. And you get to know people over time. The more you talk to them, the more situations you see them go through and see how they react and things like that, the better you can calibrate. okay, this is the best thing for this person. And massive amounts of expertise is required to do that, by the way. It's not like any advisor, if they spent enough time with you, they would be able to do this. No, it's conditional on massive amounts of expertise and cutting edge research. Then, if they spend time with you,
Yeah.
you'll get something special.
Yeah. No, and I think, do the way that we're deliberately set up to function together as wealth manager, portfolio manager, I think is important because due to the limits of what the portfolio manager could do and due to the limits of whatever their expertise is respectively is going to inhibit the possibilities for a unique individual. So the more that is on the plate and the more possibilities that a specific portfolio manager that's sophisticated, the more things that they're capable of, the more diverse range of utility curves can be accommodated for through all sorts of techniques, strategies, allocations, all these different asset classes beyond stocks and bonds, how they're assembled. So when there's a high expertise that you're dealing with, for example, in a scenario like that we work in, the possibilities get expanded where I might have a key focus on specifically the biases, the goals, what's the feeling of the client, the scenario analysis of positive, negatives, the context, as we're saying, what will losses mean, what do gains mean, then helping that get inputted into, let's say, a utility curve. Okay, that already is a feat in of itself, like we're saying. But then from there, when there's high expertise at the portfolio management level, the more can be done to fit different investors with different profiles, different goals, different utilities. And the simple fill out this form that feeds directly into a preset portfolio is absolutely not accomplishing that, although that is the status quo. Um,
Yeah, and I should probably point out, just to just finish addressing Tom's question, that the way that we do it is not only do we gauge people's utility over time and on average by spending a lot of time with them and having many conversations, but there's a huge difference that I want to point out between gauging somebody's risk tolerance and putting them on a portfolio. So, for example, like most advisors will have like 100% stock will be the riskiest portfolio, the highest risk tolerance, and then they'll like graduate it down. So like 80% stock, 60% stocks, 40% stock, 20% stock, and then the safest one, let's just say, will be 100% bonds. And then they'll gauge your risk tolerance and they'll put you in the portfolio allocation that seems to match your risk tolerance. Here's the thing, I don't believe in that. I don't believe in that because just like we talked about right now, utility computations take into account a lot of things. You understand what I'm saying? Not just expected return and standard deviation estimates, which is how these most people are doing it. So how I look at it is large differences in utility curves and shapes of utility curves don't only require different allocations in terms of assets, they actually require entirely different investment strategies, completely different investment strategies founded on completely different principles with completely different values and beliefs. Okay, that's a little bit of what we do that I haven't seen anybody really do, and it ties into utility because not every, like look, we all know things have fat tails in finance, right? Stocks have fat tails, bonds have fat tails. There's been from 1970 to 1980 a 60-40 portfolio, which is presumably the safest portfolio overall environments, lost money. From 2000 to 2010, after inflation, you're still down. So you could have decades of negative returns, even if you're invested in the safest portfolio, quote unquote. You know what I'm saying? And for somebody with a minimum risk tolerance, maybe going 10 years without making any money is not acceptable. So there's a very big limit. There's also people that really enjoy big gains, even with a small piece of their portfolio. And something like a 60-40 or stocks and bonds will never be able to accomplish that. Also, like there's people that are not happy with the current implied risk premiums of stocks and bonds, right? Like interest rates are at the lowest point, I think, in the US history. You know what I'm saying? And then equity premiums or equity valuations are essentially at 2000 levels. You know what I'm saying? So if you're investing in stocks and bonds, your expected returns are minimal, especially relative to history. So gauging somebody's utility curve and putting them in those two assets is sort of ridiculous to me.
Yeah.
But okay,
Yeah. No, and commenting also on the behavioral coaching, when the portfolio management has that capacity, it addresses behavioral coaching in sort of a preventative and a proactive way. Because behavioral coaching comes up typically when bad emotions come up. But when something is properly suited, kind of like a tailor with a perfectly fitting suit, it's a different experience than sort of modifying what we've got to your given body type. And it's a preventative approach to having behavioral biases even come up when something is properly matched and addressing someone's utility properly. And it's very hard to do that, like Gaston is saying, with a limited tool set, with a graduated scale of stocks, bonds. We talk about all the time, even just simply from an allocation perspective, not even getting into different strategies with different philosophies and their and beyond, as Gaston's talking about, even just implementing other asset classes, commodities, currencies, alternatives, etc. When you're dealing with the typical fund-based approach, stock, bond, graduated scale, it's such a limited tool set, and especially given the environment, which Gaston alluded to, the interest rates, the valuations, it's just looking like very tough to accomplish some of these things with a limited tool set. You just
yeah, I mean, to a large degree, think about it. If you wanted to take minimum risk, right, and then your advisor put you 100% in, I don't know, 10-year government bonds, which are traditionally like a super safe thing. I don't know if you would be taking that small of a risk, because the coupon that you're going to be paying is tiny. It's going to be taxed most likely. And then if interest rates go up, your duration is just going to kill your coupon. Like, think about it. If for a 10-year zero coupon bond, you have a 10-year duration, let's say, and a 1% interest rate. For a 1% interest rate increase, it'll take 10 years of your coupon to make it back. You understand what I'm saying? So you'll lose money if you buy a 10-year bond with a 1% yield, and interest rates go up 1%. You won't make money over those 10 years. You know, what I'm saying? And here I'm specifically talking about like rolling bonds. Like you buy a 10-year bond, at the end of the year it's a 9-year bond. You sell it, you buy a 10-year bond again. Because obviously, if you hold to maturity, that's different. But
right.
Most people don't hold things to maturity like that. Some people do, but
right. No, and that's typically not. I think the reason you mentioned that is that's not what's being talked about in that traditional stock bond fund based tool set. It is rolling.
Yeah, well, for me, it's just bonds seem real risky right now.
Right.
You know? And if that's the least risky option you got, then that's not going to fit a lot of utility curves.
Right.
You know?
Right.
So yeah, I mean, it's just utility curves are not linear, and they're not that simple. So you need as many tools as you can use, like you said. Yeah. So.
Absolutely. All right, cool. I think we might wrap it up for the day. I'm scanning here just to make sure we didn't miss any final questions. Oh, I saw what Tom just posted. Absolutely. That shows the disproportionate, the loss aversion curve.
Yeah, the asymmetry.
Yes, it shows the asymmetry on the downward. Exactly. Yes. Thanks. That's what Gaston was talking about in terms of the pain of a loss in the same percentage is roughly double the magnitude of the pleasure felt by the same gain on the opposite side. So let's say a 10% gain has X amount of pleasure. A 10% loss has 2X the amount of pain. And that's what a typical profile of someone who's loss averse will feel, and which is ridiculously interesting. I think a lot of people could relate to that. Obviously, that's what the data has found. So I think it's a perfect time to wrap up. Everyone, thanks for being here. I appreciate you stopping by. We're going to be back on Thursday with a CPA. We're going to be talking end of year tax planning. We're going to be talking about different things and strategies that could potentially be done proactively. There's been a lot of talk about potential tax changes on the horizon. There's obviously, that is not certain yet. So how do you manage the potential risk of it not happening? What's a smart move to do already, maybe regardless of something happening? What are some end of year tax planning and tax strategies that you should be thinking about right now with your CPA? If you aren't, you really need to take a look at. We're going to be covering all that stuff with a gentleman named Justin from MBAF, and we're going to do that live on Thursday again at noon. Make sure you don't miss that. Anybody on Facebook, again, we're going to start transitioning this over to YouTube because the stream quality is much better. I provided a link in the description. Come on over to our channel, give us a subscribe, and we're here on Tuesdays and Thursdays is our current schedule at noon. Today you had myself, John Paul, private wealth manager, and my co-founder partner, private portfolio manager, Gaston. He's a frequenter of the stream. Like I said, next stream we're gonna have a CPA tax professional on here. Please don't miss it. That's Thursday at noon. Again, this is the Wealth Management Show. I'm glad you guys made it. We'll see you again soon, and have a great week.